Indian pharmaceutical companies derive approximately 31% of their total exports from the US market, amounting to about $8.7 billion in financial year 2024. This significant reliance underscores their concern regarding President Trump's proposed tariffs on pharmaceutical imports, which could lead to increased costs and impact their profitability. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In this video, we are going to talk about the 5 major pharma companies in our country which depend significantly on the operations in the US region. We'll look at where these companies stand in terms of their financial performance and valuations, which will help you as a new investor understand where these companies stand in case you are willing to invest in them. We'll also discuss quickly what kind of impact will the tariff announcement have on these pharmaceutical companies. Recently, President Donald Trump announced plans to impose a 25% tariff on pharmaceutical imports, aiming to boost domestic production and reduce dependency on foreign drugs. This move has significant implications for countries like India, which supply a substantial portion of generic medicines to the US market. In 2022, Indian drug makers supplied nearly half of all generic prescriptions filled in the US, generating $408 billion in savings for the US healthcare system. Now, given this substantial contribution, the proposed tariff could have far-reaching effects on both the industry and investors. So let's look into 5 prominent Indian pharmaceutical companies with significant exposure to the US market. We'll explore their dependence on US revenues and how they have been performing recently. India's largest pharmaceutical company with a market cap of 3,87,169 crore and the 4th largest specialty generic drug maker globally has an annual revenue of $5.4 billion. The US is a key revenue driver for the company. It has approximately 30% of its total revenue derived from the US market. Coming to its performance. In Q3 of financial year 25, Sun Pharma's net profit rose 15% to 29.03 billion rupees, with Indian sales up 14% to 43 billion rupees. This shows a strong domestic market performance. But Trump's proposed 25% tariff on pharma imports could impact profitability. Now, as of February 25, 2025, Sun Pharmaceutical Industries has a price-to-earnings ratio of 33.86, which is a 5% discount compared to its peers' median PE of 35.71. Now, for those who don't know, a PE ratio of 33.86 suggests that investors are willing to pay 33.86 rupees for every 1 rupee of the company's earnings. Next in line is Cipla, with a market cap of 1,18,174 crores. It has reported that 30% of its total revenue originates from the US market. Cipla has been focusing on complex generics and respiratory products in the US. In Q3 of financial year 2025, Cipla reported a 49% year-on-year increase in consolidated net profit, reaching 15.71 billion rupees, driven by a 10% rise in domestic revenue to 31.46 billion rupees. Now, despite a 1% decline in North American sales, total revenue grew by 7.1% to 70.73 billion rupees. Coming to its valuations. As of February 24, 2025, Cipla has a price-to-earnings ratio of 23.94, which is a 31% discount compared to its peers' median PE of 34.48. This suggests that Cipla's stock is relatively undervalued in the pharmaceutical sector. Additionally, the company's price-to-book ratio stands at 3.99, a 24% discount to the industry median of 5.26. Indicating potential undervaluation relative to its book value. Another major pharma player with approximately 44% of its revenue originating from North America is Dr. Reddy's Laboratories. It has a market capitalization of 94,000 crores. Coming to the financial performance of the company. So the Q3 results for financial year 2025 are slightly above the estimates but declining revenue contribution from Revlimid. With Revlimid, the blockbuster cancer drug and a key growth driver for Dr. Reddy's in recent years, approaching its patent expiry in January 2026, concerns about potential revenue loss are mounting. Though some analysts believe the launch of anti-diabetic medication in Canada in early 2026 could offer some relief to Dr. Reddy's, they see it as insufficient to offset the revenue fall from Revlimid. Coming to the valuation part. So as of February 25, 2025, the PE ratio stands at 17.5. This is a 51% discount compared to the industry median PE of 35.71, suggesting potential undervaluation. Even the PB ratio is at 2.92, a 44% discount to the peers' median of 5.26, which may indicate the stock is trading below its intrinsic value. Next pharma company with US operations contributing a significant approx 36% of the revenues is Lupin. Lupin has a market cap of rupees 86,501 crore. It has delivered strong financial performance during the quarter 3 of 2025 results. While its net profit rose by 38.8% from the same quarter a year ago to 8.589 billion rupees for quarter 3 financial year 2025. Revenue for the quarter stood at 56 billion rupees, reflecting a 10.6% rise from quarter 3 financial year 2024. Lupin's North America's sales growth of 12.3% contributed to the strong performance. Coming to its valuation. As of February 24, 2025, Lupin has a PE ratio of 30.5 times, indicating that investors are willing to pay 30.5 rupees for every 1 rupee of the company's earning. Another popular player is Aurobindo Pharma. Now, Aurobindo Pharma has significant exposure to the US market with over 50% of its revenue coming from the US. It has a market cap of 62,808 crore rupees, and if you look at its financial performance, the pharma company has shown a mixed performance during the third quarter of financial year 25. While revenues rose 8.5% year on year to 79.78 billion rupees, net profit reduced to 8.45 billion rupees, marking a 9.7% decline from 9.3 billion rupees reported in the same quarter last year. As far as valuations are concerned, Aurobindo Pharma has a PE ratio of 17.99, way below its peers. Now that you know the 5 major players which are heavily dependent on their US operations, let's understand the consequences of proposed tariffs by the US government. Number 1, rising cost. Higher expenses may squeeze profit margins, especially for low-margin generic drug makers, potentially affecting US patients. Number 2, supply chain shifts. Firms may increase US manufacturing to bypass tariffs, requiring heavy investments. Number 3, competitive edge. Despite tariffs, Indian pharma remains strong in generics due to cost advantage, says Dr. Reddy's MD GV Prasad. So hope this helps you gain insights about the 5 major players in pharma sector and how they can be impacted by the proposed tariff announcements by the US government. If you found this video helpful, don't forget to like, subscribe and hit the notification bell icon for more updates. Share your thoughts and questions in the comments below. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.